In today's class, let's see what is housing finance and venture capital. These are both examples of fund-based financial services. So coming to the first term, what is a housing finance? Like the term explains, it is the finance which is provided for housing purposes, for meeting the various needs related to the construction or renovation or repair of a house. The fund that is provided is known as housing finance. National Housing Bank is an example of an institution which provides housing finance. So simply put, it refers to finance which is provided to individuals or groups of individuals. It could even be lent out to cooperative societies to buy a house or build houses. Now, housing finance is provided for various purposes. It could be for the purchase of a plot or land, provided the land or plot is purchased for construction of a house. So if you're planning to construct a house in a particular area and you don't have land there, you can apply for housing finance because you are intending to construct a house in that plot. So purchase of land for construction of house comes under housing finance. You could also avail housing finance if you want to acquire an already existing flat or house. You're going to buy an old house or a flat and you need funds for that. Then also you can apply for housing finance. Or you already own a plot of land. You want to construct a house there. Then also housing finance can be allowed. Now you have a house, you want to extend that house. That is, you want to build another room to your house, you want to renovate your house, you want to extend your house. For that purposes, you can avail housing finance. Even for repair work, maybe one room is in a very bad condition, you can demolish that room and build another room in its place. For repairs also, housing finance is provided. The last purpose for which housing finance is provided is as a bridge finance. Now, what is bridge finance? You have applied for a huge sum as a loan in a bank. Now, it requires some time before you get that amount in your hand because it involves a lot of paperwork and procedures, and you do not want to wait till that fund is received. In that case, you can avail for a short-term loan and start construction of the house. And when the actual loan that you have applied for gets approved and you get the amount in your hand, you will pay off this short-term loan and then continue with the new loans amount. So that is known as bridge finance. That is to bridge the gap or to bridge the waiting time in which your actual loan is received. You'll take a short-term loan and start your work. And when the big loan is received, the loan for the bigger amount is received, you will pay off the smaller loan and then continue with the construction. So the housing finance is also provided as a bridge finance while purchasing a house or a flat. So these are the purposes for which housing finance is used. Now let's see what are the different types of housing finance. Housing finance is provided as direct finance and or supplementary finance or indirect finance. As direct finance, it is provided for four purposes. The fund is provided for purchasing another house or to buy an old house. You might want to purchase an old house, then demolish it and construct another house, or you might want to renovate it, or you might want to repair it. So you can buy an old house with a fund which is provided. You could also get funds so that you can prepare your house for letting out. That is, you wish to rent out your house. Before you rent it out, there will be some works that you need to carry out to repair the defects of the house. For that also, you can avail housing finance as a loan. And the last one is purchase of a plot. That is, if you want to purchase land and the borrower assures that that plot of land is acquired only for the purpose of construction of a house. The lending institution has to ensure that the borrower does not use that plot of land for any other purposes. Now, housing finance could also be provided as supplementary finance. That is, you want to alter your existing house or repair your house, then supplementary finance is provided. Now, as a second mortgage, that is, you already took a loan on that particular house, but you want additional funds. In that case, you can apply for housing finance. Now, indirect finance, that is, the finance will be provided to other financial institutions, housing financial institutions, housing financial boards, who will then lend it out to people who need funds for housing related activities. So that is known as indirect finance. So these are the three types of housing finance: as direct finance to the people who actually need the funds, as supplementary finance or additional finance, as indirect finance to other housing financial institutions. So this is with regard to housing finance. Now let's move on to the next fund-based financial service, which is venture capital. So what is a venture capital? Who is a venture capitalist? What is a venture capital fund? Let's see whether we can understand these terms in detail. So what is a venture capital? See, venture capital is a long-term fund. We can call that fund as risk capital. So another name of venture capital is risk capital. So it is a risk capital which is provided to highly risky projects, which has got a high growth potential. Okay, so it is a unique project, a unique business idea which uses latest technologies, but it involves risk because it is a never before tried idea. It definitely involves risk. That business could be a success or it could be a failure. So it involves risk, but taking into consideration the various market conditions, it seems that it has got a good growth potential. It seems that the business will be a success and it will keep on growing. So if it has got a growth potential, but it involves risk and it is using high technology projects, then venture capital is provided to such business ventures, because banks normally will not be interested to provide loans for these risky projects. Then you can approach a venture capitalist for availing risky capital for high technology projects that involve risk but has got strong potential for growth. And usually this fund is provided for a long period of time because the business has to be introduced, manufacturing process to be completed, marketing has to be carried out, then production, then after all that the sales needs to pick up. Only after that the venture capital money is returned back or repaid by the borrower. So simply put, venture capital is a long-term risk capital to finance high technology projects which involve risk but at the same time has strong potential for growth. The institution or person who provide venture capital is known as venture capitalist, and the fund that they are providing is known as venture capital fund. So let's see what are the features of venture capital. It is provided in three forms: as equity participation, as convertible debt, or as long-term loan. Equity participation means the venture capitalist will purchase the shares of the company or the firm which is seeking funds. So they will become a partner of the company or they will become a shareholder of that company. And once the company starts earning profit, they will sell off these shares to either the promoters of the company or in the secondary market, and they will get a capital appreciation. That is, maybe at the time of purchasing that share was worth rupees 1,000. But when they are selling that share, when the company starts making profit, they will sell that share, and that time they might be able to sell that share for 2,000 or 2,500. So they will get a margin or they will get a profit of 1,500. Now, convertible debt, that is, they will provide it as loan. They can later convert it to equity shares or debentures if they want. That is known as convertible debt. Or they can give it as long-term loan. They will be getting an interest rate and then later on, as per the loan agreement, it will be paid back. So it is in three forms. It could be as equity participation, as convertible debt, or long-term loan. The next feature is it is an investment made in high risk but high growth potential projects. Usually it is invested in projects which has got a unique idea which use high technology, and therefore the risk is very high, but at the same time that it has got a high growth potential. Next one, it is provided only for commercialization of new ideas or new technologies. For unique ideas, the fund is provided. Then investment is usually made in small and medium scale industries. Usually when it's a unique idea, they'll start as small and medium scale and then grow to large scale sector. Now, venture capitalist joins as a co-promoter. That is, they will share the risk and reward of the company. They'll be a part of the company. There'll be a continuous involvement in the business. Their objective is not profit, but capital appreciation, because once the company or the firm or the project starts earning profit, they will sell off the share at a higher price and get capital appreciation. So their objective is not to earn profit, but capital appreciation. That is, they will be purchasing for 1,000 and they will be selling the share at 1,500 or 2,000. So they will get an additional of 500 or 1,000 per share as profit. That is capital appreciation. So these are the features of venture capital. Now, what are the activities of the venture capital fund? What is it used for? See, fund is provided as seed capital or startup capital. That is, you have got a very good business idea. It is a very unique one. But when you're approaching financial institutions, they might be willing to pay only up to 80% of the actual fund required for starting that business. Suppose you need 10 lakhs for starting that business, but the banks are willing to provide, it is not 10 lakhs. 10 lakhs is a very less amount. I'm just stating a small amount for example's sake. Okay, so if you're asking for 10 lakhs, the bank is willing to give you only up to 8 lakhs, and you are required to raise the 2 lakh from your own savings or funds that you have borrowed from your friends. Now, suppose you do not have saved funds of 2 lakh, or you have no way of raising that 2 lakh by yourself, then you can approach a venture capitalist and they will provide that initial capital which you need to raise by yourself. That 2 lakh which the bank is not providing, that 2 lakh will be provided by the venture capitalist. This is known as seed capital, and this capital is provided for initial market survey and for the initial production activities. So venture capitalists will provide seed capital or startup capital. Next one is additional capital. You have already started your business and it has turned into a success. Now you need more funds for expanding that business or diversifying your product or modernizing your Indian firm. In that case, venture capitalists will come forward as willing to provide additional capital. The third case could be as bridge finance or project financing. Now, what is bridge finance? I have already explained. So you have applied for a huge sum of money as a loan from a bank. Now that bank needs some time to arrange for the funds, complete the paperwork and give or hand over the amount to you. Maybe it will take 3 months time or 6 months time before you get that actual amount in your hand. Now you do not want to wait till then to start your business activities. So you will apply for a short-term loan to the venture capitalist and they will provide loan for that 6 months or 3 months until you get the actual loan amount in your hand, the huge amount that you have requested or applied for. Till then, a short-term loan is provided and that is known as bridge finance or project financing. Next one is equity financing. That is, the venture capitalist will join in as a shareholder by subscribing to the shares of your new company. Because it is a new company which has not yet been established, it is having high risk as well as high growth potential. Public might not be interested in investing in the shares because they do not know how that company is going to perform. In such case, the venture capitalist will step in, they will purchase the shares of the company. This is known as equity financing. Next is research and development financing. You have a unique idea, you have already manufactured that product, you have put forward that product in the market and it has turned out to be a success. Now you want to carry out further research and development activities for product development. In that case, funds will be provided for that purpose. Now, acquisition or buyout financing. You want to purchase another industry. Then in that case, not industry, you want to purchase another company. For acquisition purposes, venture capitalists will be providing funds. The last one, turnaround finance, is provided with the intention of turning around sick units to healthy units. That is, you ventured into a risky business with a unique idea, but initially it did not give you the profit that you expected. The business is currently sick. It is not earning sufficient funds. It is running at a loss. In that case, funds will be provided to you so that you can move forward and overcome that difficult phase. You can turn around that sick unit into a healthy unit. Otherwise, that unit will be shut down or closed down. So to avoid that, funds will be provided, and that is known as turnaround finance. So these are the activities of venture capital funds. Now, what are the different methods of venture financing? First one is equity participation, which I have already explained. The venture capitalist will purchase the shares of the new firm, but it is always ensured that they do not purchase more than 49% of the share. That is, they will not be the major shareholder. They will only purchase 49% of the shares. When the project starts earning profit, the shares will be sold. That is, they do not intend to hold that shares for a very long period of time. They will hold it till the business turns profitable. And once it becomes profitable, it has showed a good track record, a good performance, then the shares that the venture capitalist bought will be sold back either to the promoter themselves. That is, if there was a buyback agreement with the person who is starting the firm, that they will buy back the shares from the venture capitalist once the company starts earning profit. Then the buyback agreement will be followed. That is, at the agreed price, the shares will be returned back to the promoter of the company, or it will be given to the public in the secondary market. So this is known as equity participation. They will purchase the shares, wait till the firm earns profit, then they will sell it either back to the company or to the public in the secondary market. Second method is conventional loan. It is like a loan. They will be lending out the loan amount at a lower fixed interest rate. Once the business starts functioning commercially and it starts earning profits, then the interest rate will be increased and they will require the borrower to pay interest at a normal or higher rate. Initially, it is paid at a lower rate, but once the company starts functioning properly and starts earning profit, they are required to pay higher rate of interest or normal rate of interest, and the loan will be repaid according to the loan agreements. According to the predetermined schedule, it will be paid in installments. At regular intervals, the loan amount or principal amount will be paid. So this is known as conventional loan. Money will be lent out. In the initial years, the interest rate will be very low. When they start earning profits, the interest rate will be increased and normal interest rates will be collected or higher interest rates will be collected, and the loan will be repaid as per the loan agreement. So they are not purchasing the shares or involving in the daily functioning of the company. They are just lending out funds and then they will be repaid when the company starts earning profit. So this is the second method, which is the conventional loan. Now the third one is conditional loan. Here, the loan amount is given, and in the initial years when the project is being implemented, interest will not be collected. There is no interest on that loan. But there is a royalty on sales. There is a certain percentage of the amount that you get from sales will be provided to the venture capitalist as a royalty. Now, the benefit of this for the borrower is that if there is no sales, they need not pay anything to the venture capitalist. Only when they start earning through sales, they will have to pay a certain percentage of the sales as royalty. Now, the loan will have to be repaid as per predetermined schedule according to the agreement once the company starts generating sales and income. The last one is income notes. income notes is a combination of the conventional and conditional loan. That is, in conventional loan, a lower interest rate is charged, and when the company starts earning profit, normal or higher interest rate is required to be paid. In conditional loan, it is provided free of interest, but a royalty has to be paid once sales is generated. Now, income note is a combination of both of these. In a lower interest rate is paid in the implementation stage, and once the company generates sales, a royalty will also be paid as percentage of the sales. So this is the income notes, a low interest rate and a royalty once the sales starts will also be paid to the venture capitalist. Now let's see what are the different stages of venture capital financing. The first stage is with regard to idea generation. So an idea has to be developed. For this, in the initial stage, a seed finance is provided, that is for carrying out investigation of the market. So market research, proper market research is carried out to find a gap in demand and supply and to come up with a unique product. So for the development, maybe the person will have a basic idea, but they want to carry out further research or investigation of the market to finalize their product idea. So for this stage, a seed finance is provided, and that is the first stage. Now the second one is implementation stage. You have come up with the idea, you want to implement that idea. For that, a startup finance is provided. The startup finance is used for manufacturing that product. Now, the third stage is the fledgling stage, where you have actually completed your project, you have finished your production activities. Now you need additional funds for marketing. So various marketing related activities are carried out with the additional fund. This is the third stage of financing. Now the last stage is the establishment stage. You have captured a market for your product. You have started generating profits and income, and now you want to expand the business or diversify your product. In that case, establishment finance will be provided. So these are the different stages of venture capital financing. With that, we come to an end of this chapter. If there are any doubts, kindly contact me. Thank you. I hope it is clear.